Everyone, thank you all for coming out, tuning in person and online to this next session of Founder University. Today's session, we have 3 different speakers on a range of pretty technical topics for new business owners and people thinking about starting a business. And I'll make an introduction to each of our speakers as we kick off each part of this session. And starting off, we have Christopher Peters. Christopher is a tax manager with KPMG, and he specializes in identifying and supporting federal and state tax savings related to scientific, technological, and engineering activities employed by companies. While he has served his clients in a variety of industries, Chris has developed a specific expertise in technology and financial services industry. And in his spare time, he enjoys golf and anything related to soccer analytics. Chris, we really appreciate you joining us.
Thank you so much for the introduction. I didn't know you mentioned soccer. I was going to start talking about soccer all of a sudden. I can talk about that if you like. No, I'm getting too distracted. No, today we're talking about taxes. So really today, before we get started, I really want to talk about what we're going to be focusing on when we talk about taxes today. There are many different types of taxes, but today, because you are business owners and future business owners, I really want to be focusing on corporate taxation and more specifically, corporate income taxation. Okay, so when we talk about these concepts, they will be typically looking through that lens of corporate income tax. We will be touching on a couple of different topics, but that's sort of the lens and focus of taxes. I understand there's a wide variety of taxes. I don't want to bore you with all of them, but today we're really going to be focusing on that income tax for corporations. So when I was putting the slide deck together and really trying to figure out what was the one takeaway that I wanted to get, I was practicing this with my wife, who also has a tax background as well. And as I was going through the slides, I was talking with her and she was saying, Chris, what are you doing? Every slide you're saying, talk to your tax advisor, talk to your tax advisor. You're like a broken record. Just, stop. So I was like, well, that's the main point. That is the one main takeaway that I would like you to get from this presentation for the next 30 minutes. Talk to your tax advisor. She told me I could say it once at the beginning, so this is my one time. My wife is typically correct, so I'm going to follow her lead. So really, as we go through this, understand that what I'm trying to fulfill today is giving you a high-level understanding of the concepts so that you are aware of them, so that you can go ahead and talk to the specialists about certain tax, whether it's a tax event, a tax implication, things of that nature. You can go talk to them and get the advice that you need. Okay, so let's get started. There are a lot of different topics that we're trying to cover today. So again, looking at it through the lens of really the corporate taxation, income taxation, right? So we're going to start with a simple computation of tax, right? How do we get to taxable income? How do we calculate your tax liability? Talking through different entity types. These are going to be the vehicles that you can utilize when you're doing your taxation. In addition to that, again, we are going to touch upon individual tax very lightly, okay? So when we talk about individual taxation, I just want to talk about some of the tax brackets, right? In addition to that, we're going to be talking about taxes a lot, so let's talk about some of the incentives. Let's talk about some of the things that your team can utilize to reduce your tax liability and ultimately your tax bill. Later on in the presentation, we'll talk a little bit about Nevada-specific incentives. We're going to talk about, as a startup company, you may not be generating taxable income right away. If that is the case, what can you do, right? So in the first, we're going to talk about that a little bit, and that's called a loss position. And finally, we'll kind of put everything together. We'll talk about a few different specific tax issues, these tax events that you really need to be aware of as you continue to grow your business going forward. Okay, let's go ahead and get started. Oh. I was going to do this. Okay. First slide here. Again, the takeaway from this slide that I really want to convey is that this is the basic computation of tax. Okay. Think of it as an income statement. It's pretty simple, right? Again, we're talking about a high level. There are technicalities in here, but understanding the concepts at a high level is very important. So you start with your total income, right? All your different revenues. Against that, you will go ahead and take your deductions. So these are the different expenses that are allowable for to reach taxable income. When you reach taxable income, this is really the amount that is going to be liable for tax, right? And again, looking at it through that corporate veil, looking at the corporate lens, you're going to see that corporate tax income, there's a tax rate of 21%, right? So once you get your initial tax liability, you will then be able to apply credits to them. Now, credits we're going to talk about in a little bit more detail later on, as well as deductions. These are more, these are sort of lucrative $1 for dollar credits that you can apply towards your tax liability to reduce your final tax bill. Okay, so again, at a high level, we want to just understand the concept of tax, understanding that you start with income, you take away your you take away your deductions, you reach taxable income, and ultimately you apply your credits before arriving at your final tax bill. So one more thing before we move on this specific slide is most corporations, they tend to file on a calendar year, right? So that means that your tax year will equal your calendar year. December 31st will be at the end of that calendar year. Your tax filing is due typically 3 months or 4 months after that, okay? Again, at a high level, depending on the entity, that is when you need to file your taxes. Your tax liability, your tax due, it needs to be paid with your tax return, okay? You can apply for an extension. You can extend your filing of your tax return, but you need to understand that it's not an extension to pay your tax bill. You need to pay your liability, right? You cannot extend that out. Again, high level, understanding how to get to taxable income as well as tax liability. Okay. Entity types. The main concept here that I want to convey is that there are two main tax vehicles, we like to call them. All right. So I've broken these down into two different categories. The first category is going to be what we call a corporation. All right. The second one is going to be called a pass-through. The main difference between these two categories is going to be that the corporation is going to be taxed at the corporate level, right? So a corporation is going to be taxed at the corporate level, and then that income is also going to be taxed at the individual level as well. So this concept is known as double taxation, and we're going to talk about that a little bit more. But the second category that I want to talk about is what we call pass-through. So if your entity is a pass-through entity, that means that any income generated by the corporation will be then passed through to the individual level and will only be taxed at that level. So then you're going to be avoiding that double taxation. So then you may ask me, hey, Chris, this is great and all. Why would anybody do a corporation and get taxed twice, right? What were the advantages of that? I'll just do a pass-through entity and we're good to go. There are advantages and disadvantages for each category. So at a high level, a corporation can have more than 100 shareholders, right? A corporation can have different types of shareholders. They can have foreign shareholders, right? They can issue different class of stock. If you want to go public, guess what? You have to be a corporation. So understanding which tax vehicle will best fulfill your needs as a company, as well as being tax efficient, is most important here, right? So again, I promised my wife I wouldn't say this, but talk to your tax advisor, please. And they will tell you what is the best vehicle for you and help you plan not an efficient tax company, but also just what meets your needs and what you're trying to fulfill as a company going forward. Okay, so we'll pause right here. Up until this point, we have been really talking about federal taxation, right? So we're talking about taxation at the federal level. We need to understand that there are other taxes as well, other tax jurisdictions. So if we start at the federal level, your company may be subject to also state taxes as well. So we know that a great incentive of Nevada is that there's no income tax, but you may be subject to other taxes as well, right? And then even from the state level, you may be liable for local taxes, right? City taxes, county taxes, things of that nature, okay? So it's really about understanding, it's not about understanding all of the tax rules, but understanding that as you do business and as you grow your business, you may be generating different tax liability in different jurisdictions depending on your type of activity. Okay, so understanding what may cause nexus to a different state, a locality, and understanding that, hey, these are things I need to look out for when you're doing business. Okay, last thing you want is to get a bill, a fine, a penalty because you didn't pay your taxes. And guess what? On top of that, I think they charge you interest on top of your penalties and taxes as well. So that is what you want to avoid. Again, just be aware that there are other jurisdictions. And the final category we have here is foreign. As you grow your business, again, you may start doing international transactions that may, that may be able to, you may have to get foreign taxes as well. So understanding that each country has their own tax rules, and even each foreign country may have their own jurisdictions within that country that may cause other tax implications. So again, main takeaway, understand that there are different jurisdictions that you may be liable for tax. Okay, we're going to pause here real quick, and we're going to pivot over to individual taxation, just again, at a high level. So kind of building on that concept we did a couple slides ago about those pass-through entities, right? So those pass-through entities, you generate income at the corporate level, and from there, that income gets taxed at the individual level. I think one of the biggest misconceptions that a lot of people have, and it's very easy to think that, they think that if you have a certain amount of income, you are going to be liable, you are going to be taxed at that level, right? So say, for example, somebody's making $50,000, right? They have $50,000 of income. They think that all that $50,000 will be taxed at that 22% rate, right? The US government, they have a progressive system. So that means that as you progress up these tax tiers, up these income tiers, you will be taxed at different tax rates. So again, walking through the example very quickly, we can see that if somebody is generating $50,000 of taxable income, right, that first $10,000 is going to be taxed at that 10% rate, right? Any dollar above that $10,000 up until the $42,000 will be taxed at that 12% rate. And then anything from that $42,000 up until that $50,000 is going to be taxed at that 22% rate. So really, you're only paying taxes at that 22% rate for that $8,000, while the rest of that income is being taxed at a lower rate. So understanding this concept is not only going to help you file your own taxes, but just also understanding how tax brackets work in the United States. Okay. All right, so up until this point, you're probably saying, Chris, between federal taxes, between state taxes, between local taxes, between county taxes, between corporate taxes, and then I get taxed again at the individual level, is there anything left over for me? No, not really. I think that's it. That's the end of my presentation. No, it's not. So there are two main ways to reduce your taxes, right? And we're going to talk about that a little bit here. So the first one we touched upon before, we talked about deductions. Deductions are really expenses that you can apply against your income to reduce it, so to get to that taxable income, right? So again, there are different rules for taxes. There are different expenses that apply for taxes. So that means that you really need to be able to work with your tax team to identify those deductions that you are eligible for, to reduce your taxable income and ultimately pay the least amount of tax that you need to. Credits are another area that you are able to reduce your taxes. So credits is an area that a lot of governments use, right? So federal government as well as state governments, they use credits as sort of a lever to really incentivize companies to perform different behaviors, right? So nowadays you may have heard about a lot of incentives around clean energy, right? So they want to incentivize companies to utilize clean energy and go in that route, go into the future. So they provide credits to companies that are moving towards that, right? Another one that I deal with quite often is the R&D tax credit, right? Many of you may be dealing with technology, right? Many of you are developing new types of software. So what does that mean then, right? Well, we see that a lot of companies are shifting their software development offshore because it's much cheaper, right? So what does the government need to do? The government wants to incentivize companies of using onshore resources by providing a credit for any individual that may be doing software development onshore, right? So just as federal governments kind of use this as a lever, local governments, state governments also use this to generate additional income, but also make the local area attractive for new businesses to start. So again, main concept here is that there are benefits and incentives out there for you to reduce your tax liability, right? But again, it's on you, the taxpayer. The burden is on you to identify which ones you are eligible for and then ultimately apply them to your company. Okay, Nevada specific incentives. So we touched upon this a little bit when we talked about incentives in credit form and deduction form. Nevada specific incentives, the Governor's Office of Economic Development, again, they want to make Nevada an attractive place to start a business. And they do this in a few different ways. One of the ways that they do this is really through tax abatement, so a reduction in your tax rate. Now, again, we don't need to walk through each one of these to identify what they are. The main takeaway here is that I want you to be aware that these things are out there, and that also, in addition to that, the burden is on you to go and apply for them and see if your company is eligible so that you can take advantage of them. And again, broken record, talk to your tax advisor. There are specialists out there that deal with these types of things specifically, and they will be able to identify them for you so that you can take advantage of them. Okay, all right, so you're going to say, Chris, this is great. We talked about taxes. We talked about all the money that I'll need to pay to the governments, all the different governments. That's great. I'm a startup, right? I'm going to be starting my business. I may not generate any taxable income for a year, 2 years, maybe multiple years. Okay, if that's the case, what happens, right? And this is what we call kind of a loss position, or we call net operating loss. All right. So the easiest way to understand net operating loss is to kind of go through an example, but the main concept is this. If you are not generating any taxable income, that loss can then be applied to your future years, right? It can be carried forward to your future years until you are generating income. And then you can take advantage of those losses that you generated throughout those years to ultimately reduce your taxable income, okay? So maybe walking through a quick example right here. So you're ABC Corp. You start in 2023, you're ramping up your business, you have income of 100, but ultimately your expenses are higher than that. So you have a taxable income of negative 100. You can carry forward that loss to the next year for 100, right? 2024, kind of same thing happens. You're still ramping up. You have more expenses than income. You have an additional $100 loss. Now you have a loss carry forward of 200. Finally, in 2025, business is going great. You're starting to generate some of that income. You now have taxable income of 100, okay? Now remember, you have that 200 loss carry forward. You can apply up to 80% of that against your taxable income to ultimately lower your taxable income to 20, and you only need to pay taxes on that 20 instead of 100. The rest that you did not utilize gets to be carried forward indefinitely until all of it has been utilized. So understanding that even though you are not generating any taxable income, understanding, keeping your team, keeping your tax team engaged and understanding how they can benefit those loss carry forwards to ultimately apply against your tax bill going forward. Okay, special tax issues. These I like to call tax events, okay? These things may happen to you in your future. Hopefully they do, especially the IPO. I think that's what everybody wants over here. So understand that when these tax events happen, there will be tax implications, okay? So I want you to really understand that the concept of these, we don't have to go through them in detail, but understand that there are specific events that will happen, and that should trigger a warning and go, hey, look, that will trigger a significant tax implication or tax liability. I need to bring in my tax team and talk about how to structure this type of event, right? So whether you are being acquired, whether you are acquiring another company, understanding how to structure that ahead of time instead of dealing with it, retroactively, you need to bring in your tax team so that they can structure it to be more tax advantageous. Okay, so we'll start to slowly wrap up here and really putting everything together. The goal of this presentation was really to understand that your corporate tax planning team, your tax advisors, they are not just there until at the end of the year, right? December 31st happened, Happy New Year. You wait a couple months, you give them a bunch of receipts at the end of the day and be like, hey, here we go, please do my tax return. Keep them in the loop, keep them as part of your advisement team. Not only will they help you run an efficient business, make better decisions for your business, they will be there to help you and run a better tax efficient company going forward, right? So they are really part of your tax plan. Okay, that's it. So the conclusion, there are three main things that I want you to take away from this. Really two main things. The first one is that think of your tax team, as I just mentioned before, as part of your business advising team, right? I understand they're typically not always in the room. Keeping them in the loop will allow you to plan better for your company going forward as you continue to grow. The second thing is that I want you to remember there will be some point in the future, a tax event will happen, and you will say, I remember that one guy, he was on the screen, he said one thing about this, something about that. I need to go talk to my tax advisor, okay? If you can remember that, this has been a successful presentation. So that's all I have today. Thank you so much.
Excellent. Thank you so much, Christopher. Appreciate it.
Thank you, no problem.
But first question, how do foreign countries determine tax for U.S. companies selling products to their citizens, like over the web?
How do foreign companies determine?
So if a U.S. entity is selling products overseas, are they liable for any tax in that foreign country? So I guess if they're importing them and selling them.
Typically, yes. If you're doing any transaction overseas, you will typically trigger tax, right? So you will have to pay taxes in that foreign country. Again, I'm going to always preface everything by saying it depends on facts and circumstances. But generally, if you are doing a transaction in another country, that will trigger a tax event, and you will be liable for taxes. Now, there is a concept of foreign tax credit. Okay, so if you pay taxes in another country, you can receive credit for those taxes paid in those countries for your own country, for the United States. And again, it depends.
Thank you so much. Chris, the next question. Any special way we should label / list our R&D entries in our financial reports to take advantage of a tax credit? Are there criteria to qualify as an R&D tax credit?
Oh, okay. Well, this is what I do every single day. So I will always say yes, definitely. The easiest way to identify in your books is either by job title or department. So have a specific department that is labeled R&D or software development or technology, right? That will be the easiest way to identify that. To identify whether the activities these individuals are performing qualify for the R&D tax credit, this really comes down to a more complicated test. It's called a 4-part test. It needs to meet, are they doing something that is new and improved, right? Is it technological in nature? Is there a process of experimentation? There are more specific tax rules that you need to apply for the tax credit. And then also there's a complex calculation. It is a very lucrative tax credit. Many states also have it. So you can kind of do a double dip. You can take it at the federal level, then also at the state level as well. But what I would say is talk to your tax advisor. But then in addition to that, again, yes, make it easy for them to identify, right? What you can typically do is you can go to, say KPMG. We do this all the time. You can ask for, hey, can you do a quick phase 0 and identify what the potential benefit may be. The easier you have, the better organized you have your data, the easier it can be to identify what the potential benefit may be.
Excellent. And last question, and now I think this is so how do you value shares awarded in a pre-revenue startup? I'm assuming for tax purposes?
For tax purposes?
Yeah.
This is out of my wheelhouse. So I am going to say on the next slide, what you can do is if you have any specific questions dealing with startups and things of that nature, we do have a specific group called Private Enterprise Group that deals with startups, that helps them, it advises them through all levels and all stages of their startup. So whether that's, at the very beginning when they're doing more pitches and things of that nature, all the way through IPO, acquisitions, things of that nature, I would say, reach out to me. I can put you in contact with these individuals as well, and they'll be better to answer questions. So hopefully that's helpful.
Christopher, I really appreciate your time.
No,
Thank you so much.
Yeah.
All right, everyone. Thank you so much for your patience. We are back with our next speaker, Deeta Clifton. Deeta is an award-winning founder of The Office Squad. She served for 6 years in the Air Force, working in an F-15 squadron operations, where she met and married her husband. While traveling in support of his fighter pilot career, she raised 2 daughters and opened her own small business to help others with theirs. For the last 21 years, she has dedicated herself and her company to the support of small businesses. And in 2022, Deeta franchised The Office Squad business model is on a mission to change the way we grow small businesses in America. She now teaches business owners how to do what she did, only faster, better, and smarter. Thank you so much for joining us, Deeta. The floor is yours. Appreciate you so much.
Afternoon, everybody. Thank you for having me. We are going to talk a little bit about accounting and payroll, but this is a big help for what the CPA just talked about, record keeping. I'm going to tell you a little bit about me, why I'm a so-called expert and what makes me worthy of being up here showing you what to do. We're going to talk about bookkeeping, operations, and accounting, what the difference is between those 3 things and how important they are to your business. We're going to talk about software, accounting software. What do you use to keep track of your bookkeeping? And then a little bit about the basic things that you need to accomplish your bookkeeping, vendors and W-9s, a little bit about payroll, and then how to create and how important it is to create daily, monthly, and quarterly, yearly habits revolving around your numbers. So what makes me an expert? I have been in the bookkeeping field for over 30 years. I'm a QuickBooks expert and an operations expert. I can make things run smoothly most of the time. I'm 21 years as the CEO and founder of The Office Squad, created that as a little bookkeeping business from home. I'm a certified woman-owned business, veteran-owned business, and a small business enterprise. And why that's important is, I didn't know it at the time when I was trying to do military contracts, but once you go through these certifications, it proves that you're real. They check your books, they check your past, they make sure that you are who you indeed say you are, and so that your clients know that you know what you're doing and you're certified to do so. So that's an important mark for a bookkeeper. I like to throw this picture in here because it's a flash from the past. This is the 8th Tactical Fighter Squadron in Alamogordo, New Mexico, and I am this very unhappy teenager here in the middle. But my job was to keep this group of fighter pilots ready to go to war at any given time with paperwork and phones and time tracking and that kind of stuff. So that's where I learned my expertise. Then I met and married a fighter pilot and began traveling the world and doing volunteer things, because that's what wives of military guys do. In 2001, we got assigned to Nellis Air Force Base, and I started a little business called Deeta's Virtual Assistance and Bookkeeping. Started working with entrepreneurs and startups, business owners. And I discovered very quickly that these people that are starting and running businesses are very much like a fighter pilot. They want to do one thing. They want to do their thing. They want to go fly. They don't care about the rest of it. So you as a startup are totally engulfed in your startup. And the rest of this stuff just has to be done, but you don't really want to do it. So now we're on the subject of accounting, which in my mind is not bookkeeping, and bookkeeping is not accounting. So we're going to define the difference. Bookkeeping is the process, the day-to-day process of recording the financial transactions. That means talking to the vendors, doing the invoices, writing the checks, going to the bank, all of those little things that make handling the money for your business. That's bookkeeping. And anyone can be a bookkeeper. Excuse me. No degree, no license, no certification, no test. Anybody can say, I know QuickBooks, I'm a bookkeeper. Accounting is a totally different animal. It involves analyzing, interpreting, summarizing your financial data, and using that information to help management, investors, stakeholders, and your CPA, your accountant, look at your books. It involves bookkeeping, but that is not what it does. And an accountant has to have a degree, and a CPA has taken a test to certify that they are a satisfied, certified public accountant. There's a huge difference between bookkeepers and accountants. That's why the price is different too. And the last thing I want to touch on is operations. Your bookkeeping, your accounting, your production, distribution, marketing, sales, customer service, anything that goes into making that back office work and produce your product or your service is an operation. One more time. Bookkeeping is the recording of the day-to-day stuff. Accounting is the interpretation and analysis of the data that the bookkeeper has provided for you. And operations is the day-to-day activities that keep it running smoothly. While all three of these are related and they overlap, they all have something different to do in your company. And which one do you think is payroll? I would go with bookkeeping. As the startup and the founder, you are wearing all of those hats, most likely. And if you are wearing all of those hats, you are doing those things. And if you're like the fighter pilot, you don't want to do them, so they get pushed to the back until they start yelling right around this time of year. So if you're not doing them and you delegate them, you still kind of need to know how to do them so that you know they're doing it right. Trust but verify. In my line of business, we see a lot of small business owners that have gone out and purchased or started an online accounting software data service. QuickBooks, FreshBooks, HoneyBooks, Wave, Zoho, Sage, Xero, Patriot. There are a ton of them. And unfortunately, a lot of people do it and they pick one based on price. It's cheap, it's free, I'm going to give it a try. Well, the reason that it's free is because they want you to get involved in it, put all your data in it, and then you're going to have to upgrade it. So please keep that in mind when you choose your accounting software. And if you are a business, or are you a hobby? If you're a startup and a founder with huge dreams and investors, you're a business and you need real software. I would suggest QuickBooks or Sage or something on that scale, because Zoho is a CRM. It is not an accounting software, and Excel is definitely not an accounting software. Does it work with your payroll system? Your accountants are going to ask you that. Your bookkeeper is going to ask you that. Gusto is very popular right now. It works with QuickBooks Online. Everything syncs. Everything is so easy. It all syncs. It all works. That's what they tell you when you buy it. But when you give it to us, the bookkeeper, and we tell you, no, this does not work, please believe us. And the last thing is, don't change your accounting in the middle of the year. I got a recent client that started a new account in November because the partner had the other books. So now he has two sets of books and one started in November. Okay, I got that off my system. So now we're going to talk about how these things, a few things that you need to do your bookkeeping, things you need to keep track of. Startup cost. This net loss that Chris talked about, all of the numbers that you need, all of your startup, save every receipt, put every number in your QuickBooks. I'm going to say QuickBooks because that's my choice. You can take a picture of a receipt and you can click and drag it to your QuickBooks, and your receipt is attached to the transaction in the accounting software. Everything you purchase before you make revenue is a startup cost. All of that is deductible. Bank statements. Anybody here ever opened a bank statement? And I'm talking to one in particular person who probably never has. Online banking is great, but you still need a bank statement because you need to reconcile every month, every account, anything that has money in it. So what you want to do is go to your online banking, you want to download your PDF, and you want to save that to a folder. Electronic folders are great. And here's another big pointer. When the pandemic hit and everybody wanted to apply for the PPP, guess what they needed? Current financials and copies of bank statements and copies of tax returns. Very important. Keep them, download them, save them. You're going to need them. Ditto on credit cards. Every credit card statement, download a copy, keep it in your files. Reconcile them every month. And I'm going to go a little bit out on the limb. If you have a personal card, and we all do, we all start our business by pulling out our personal credit card and go into town. If that personal card is only being used for business, and I mean only, you can put that in your QuickBooks, but you must reconcile it. And if you use it for personal, you have to put that in there as a loan or equity or something different. But you need to do it, you need to reconcile it. If you're using a personal card occasionally for business, please do not put that in your business QuickBooks because it's not a business card. We can show you how to do that later with equity and loans. Pay close attention to the charges, expenses, our tax deductions. Put them in the right place. I don't have a whole lot to say on payroll because I don't think that startups and founders are actually going to have a lot of payroll. You're probably going to pay yourself, and you might do that through a draw. So if you decide to pay yourself with payroll as a W-2, then we're going to be talking about you need to be a corporation and you're double taxed. Do you really want that? If you have employees and you are, no kidding, doing payroll, that means they fill out a what is that thing called? No, that's the one you get. W-4, thank you. You fill out a W-4, you put them in your system, your payroll system, you are subtracting taxes from their paycheck, you are matching their paycheck, and you are sending that money to the government. That is payroll. If you are paying someone that is a vendor, that's a whole different subject, and that's probably next. Ta-da! If you are paying anyone that is not an employee, not that paycheck we just talked about, and you pay them over $600 in a year, now that may not sound like a whole lot, and I'm only paying Joe for moving furniture, and it was only $100 bucks. But what if Joe comes back 6 more times during the year, and you're paying him a little bit every time? That's going to add up to over $600 a year. And then at the end of the year, when you get ready to send Joe his 1099, you don't have his address, you don't have his phone number, you don't have his tax ID number, because you just gave him $100 bucks. So you need W-9. I like to tell my clients to put a little sign on their desk that says, no W-9, no check. So you get the W-9, you put them in your accounting software correctly, then you write a check. Just make it a habit. Anyone that's not an employee gives you a W-9. Cash versus accrual. Everybody thinks this is really hard. It's really not hard. And you need to pick one. Pick one and stick to it. Yes, it's very nice to look at your P&L and your balance sheet and the cash mode because you can see the number that you got at the bottom. But if you're sending invoices and collecting money later, that's accrual. And here's my example. If you are selling tennis shoes and someone buys tennis shoes and they give you money for the tennis shoes and you give them the tennis shoes, that's cash. That happened that day. And you can post that in a cash account in accounting. If you sell a whole pallet of tennis shoes to the neighborhood shoe store and you send them an invoice and they're going to pay you later, that's accrual. And the difference is it didn't happen immediately. And the date of your invoice to that store is the date of the transaction, the date that you count the money. Doesn't matter if they pay you 3 months later, the date of the transaction on your invoice is the date of the sale. So when you look at your finances and you're trying to plan the future and you're really accrual, but you're looking at cash, really hard to plan. Hope I didn't confuse you any more than you already were. We want to pay attention to accounts receivable, which is part of that accrual thing. You manage your accounts receivable on a regular basis. I will show you how to look at that in a P&L in a minute. You need to send out your invoices promptly. We don't have any trouble as business owners sending out invoices promptly. We want to send those suckers out fast. We want to collect that money. But we're not always looking at whether it actually got taken out of the QuickBooks. You make an invoice, you receive the money, you have to go back and post it toward the transaction in your QuickBooks. A lot of people forget to do that. Late payments can impact your cash flow. Stupid phrase, we all know that. So you're going to watch this part really close, I'm sure. I posted this picture because there is something very wrong with this. When you look at your finances, you should never see a negative on your P&L or your balance sheet. And this one stuck out like a sore thumb to me. It's negative $14,000 and some change in the AR. So this to me in your accounting means that you've been receiving payments in your AR, but you're not posting them toward the bill that's sitting out in accounts receivable. And so your checking account looks good, but your balance sheet shows that people still owe you money. And that's counting money twice, just so you know. Accounts payable is the other side. This is Craig's design landscape service. He's doing pretty good. He's got one current, not too much overdue, and yay, nothing 60/90. This is the amount of money that people owe, that you owe other people. Get that backwards. This is the credit that people give you. So if you are paying the Cox cable bill within 30 days, then you're on time. This represents a liability to your company and it's recorded on your balance sheet. You're not going to see this in the P&L. So make sure you're checking your balance sheet. You're looking for negatives and you're paying attention to what's 30, 60, 90. Because if you go and you pay a bill, but the bill is still sitting out in your AP, you have not connected the dots. So this is a dashboard for QuickBooks Online. And I wanted to show you how pretty it is. We like syncing, we like looking at the phone, we like looking at the, the pretty dashboard, and it shows us the graphs and oh my gosh, we're a little bit negative there, so we need to move money. And why doesn't, this is a quick picture. This is not the entire picture. It's like checking your bank account and making sure you got money in it. Still not the whole picture. This is the whole picture. This is your profit and loss or your income statement. This is your balance sheet. They are two very different documents. And I learned this the hard way. I only cared about this one, just like you. All of the money that goes in, what I'm spending, what the bottom line is. But if this bottom line, it actually didn't make it to the screen, but if this bottom line is a positive number, there are a lot of business owners that come to me that go, it says I still have $2,500 at the end of the month. Where's the $2,500? It's over here. In the bills you paid, the equity that you've spent, or the loans or the credit cards, those are all over here. So you need to look at cash flow and you need to look at both these reports. And neither of these reports need to have a negative number, ta-da, and they don't. So Craig's doing okay. Habits. Start now. Collect your receipts. Take a picture of the receipt. Attach it to your QuickBooks. Look at your accounts and reconcile them every month. If you do it every month, it takes less than an hour. I do it sometimes every other day. It's called the soft reconciliation, and I do it to make sure that I'm on target for what I'm up to. Reconcile your bank statements, reconcile your credit cards, loans and interest. Those are really left out until the end of the year. Look at your P&L. I'm a stickler. I hate the word miscellaneous or uncategorized. If that is in any books that we have, it goes away very fast. Understand what your accounts mean. No negatives. That's kind of a big red flag. Look at your balance sheet. An hour a month will save you thousands of dollars, and your CPA will love you. The next thing is learn how to delegate. Once you're a little bigger, got a little money, you don't want to do all these things. Who's going to answer the phone, do the marketing? How are you going to hire help? All of these things that help run the back office of your business. All these things are operations. Who's going to do that? We don't want it to be you. Questions?
David, who asked the question, if you feel free to elaborate on that, I'll try and phrase it one more time. How do you handle sole LLC expenses, ? On regular IRS income tax reporting, ?
So if it's an LLC,
Yeah.
it has its own bank account, or it better have its own bank account and its own set of books. It's not your personal, it's your LLC. It's a whole different ballgame. So you need two separate things. If you haven't done that yet, we need to chat. But yes, you create your LLC, you open a bank account, and you do all of your accounting in that business bank account. And then that number that shows up at the end of the year in your financials goes over to your Schedule C. I love having a CPA here nodding his head. Right. Yes, I'm right.
He elaborated. I am writing checks from my personal account. I do have an LLC bank account. So are these loans?
Yes.
All right. Thank you. From another, he says, thank you.
You're very
Dot, dot, dot. I have another, can you share the office squad's pricing for monthly bookkeeping services? I will for sure, Justin online, I will for sure, I would put you in contact with Dita and her team and send over that information to you. I'll get that from you as well.
Thank you.
Yes, we can absolutely share that.
Online, theofficesquad.com. And we don't work on an hourly basis. We work on a task-based, membership-based. So give us a holler.
Excellent.
Thank you.
Dita, thank you so much. Appreciate you. I'm happy to introduce our next speaker, Ezekiel Riselis. Ezekiel is a representative of Durante Insurance and Financial Services, an independent insurance agency local to Las Vegas and servicing multiple states. Ezekiel's primary focus is on loss control and advisement for startups from all the way from startups to large businesses. He's an Air Force veteran with numerous accolades and mentored startups in Austin, Texas as a volunteer for many years. He's an advocate for the startup ecosystem and has accumulated a lot of experience in strategic operations and risk management, to include management of programs with assets over billions of dollars of value. So excellent to hear from two Air Force veterans here today. So, Ezekiel, thank you so much for joining us. Please take it away.
Thank you for the introduction. So to expand a little bit on my experience, I actually worked in the Air Force AFWorks program. The AFWorks program was essentially a grant for the military to provide to startups whose technologies worthwhile for the military, and it gets up to 1.5 million per startup. One of my role was essentially sitting in a panel and listening to pitches and see if it is doable for the military. And another thing that I was in charge of was risk assessments. That was a big thing for the military. I've developed multiple regulations that's still currently being used in the Air Force right now. And so, yeah, and that's how I just got started in the insurance world. So to start off on the next slide, I'm just gonna put some bad numbers up here. It's nothing to scare you guys, it's just to show the reality of what potentially could happen when you own a business. So these are some of the bad numbers. With these numbers, we're talking about mostly lawsuits. The reason being, because insurance does cover lawsuits. It's not just, oh, my equipment breaks down, I have to go replace it. The main issue and the main lawsuits that we normally see in the insurance claims are normally EPLI. EPLI is employment practices. That doesn't mean just hiring. It also means if you have an employee and they feel like they are not getting paid enough, or there's a wage discrepancies, or they did not get promoted. That is when you'll start having lawsuits. Even if you have everything in place, procedures in place, there's still going to be legal fees and legal costs whenever somebody tries to sue you, even if you know you're going to win. And that's where insurance comes in and tries to help out, make sure that lawsuit essentially won't shut you down. Another common lawsuits that we see in insurance claims is intellectual properties. Another business may think that you're using the same branding or close to it. That's a big claim in the insurance world when it comes to businesses. And then with businesses, it's not a matter of if, it's mostly a matter of when a lawsuit happens. It could be something small, somebody just saying, hey, I tripped and fall in your building, or it could be as large as multi-million-dollar lawsuits where they're claiming, hey, you're taking part of my product, part of my operation, or part of my advertising and using it to scale your business. And also with this, currently the biggest claims are going to be cyber. Any tech companies, even if you're just writing codes, in the US, it's a big target. If you notice on the bottom right here, it's $9.4 million average loss last year for a tech company. Globally, it's only 4.35, but US tech companies and startups get targeted easily just because of the fact that there's large data, large money moving around. And these losses are not just lost to your company. What would happen sometimes if you provide software or code to a company as a B2B kind of model, if they lose income or they have losses, you are liable for that losses as well. And that's when insurance comes in and kind of mitigates your losses. So who we are as an agency. The Durante Insurance Agency has about 1,500 business clients. There's actually only 5 of us that does commercial insurance. And I'm thinking the newest one, but us five total, we have a combined experience of 130 years insuring or risk assessments. I'm mainly focused on risk assessments and ensuring startups get what they need and get properly covered. And we also have over 200 insurance carriers and programs that I have access to. And that means it's not just, hey, I'm gonna put your stuff in the platform. We actually talk to the underwriters and talk to their risk team of what insurance are looking for in businesses. So we kind of know what they kind of looking for and what they want, and in terms of insurance and how to lower that premium. So it's a quick little overview. Again, it's just gonna be a very generic insurance slides, just because of the fact that it's so complex and there's a lot, each business is going to be different. So the first thing we're going to talk about is terms. The terms are just going to be based on what I have on the slides. We're not going to go over the whole insurance code terms. Then we're going to go over, is it too early? And then the core insurance protections that you need. So here's some of the terms I'll be talking about in a slide. The insurance carrier, that's basically your insurance provider, the company that's providing the policy to you. As a broker, we don't provide the insurance to you. It's a carrier. We just kind of your middleman trying to negotiate all the things and figuring out what you need. The premium is basically the cost of the whole policy, and normally is in an annual platform. And then your co-insurance. In Nevada, there's an 80% cost to value ratio that is mandated by the state. So that means that if you have an equipment that's worth $100,000, you have to cover at least 80% of that on the insurance. If you say, oh, I only want to cover $50,000 of it, the insurance company does not have to pay out for that loss because technically the full value of it is $100,000. So as long as you meet that criteria of 80%, the insurance company will pay out by law. Now, is it too early? We like to say it's never too early to start thinking about it. Of course, if you're going to need to, so this is a pretty tricky question because some companies, some businesses, if your operation is brand new or you have new products, you may already need to start thinking about insurance or talking to an advisor before you even start, modeling your operation. Now, the reason why I say that is because the perfect example, I just had a client. She does RV management, but also in the same entity, she does RV storage and then RV rentals. No insurance will cover her. She got rejected on every single one of them. Actually, no, I take that back. There's one, and they wanted $100,000 per year. And that's the issue. If we were to just get before she started the company and split it to where one entity will do the RV management, one will do the storage, and then one will do the rental, and it'll just be operating under DBA, the insurance carriers will not care. Because now what they're doing is what they're seeing is the risk has been diversified. So, and that's the main reason why you don't want to start an operation without thinking about the insurance. Now, if it's a regular mom and pop kind of retail store, then it's not really a big issue. But the biggest issue is when it's something that's new or complicated operations. So for the next slide, we're going to talk about general liability. This is basically the core coverage that you would see in every single insurance policy. The general liability protects against claims on basically your bodily injuries, any property damage, and in some cases, advertising injury. Advertising injury is if you made a false advertisement or you advertise something that you cannot complete on a promise with. That is part of advertising injury. Now, we normally see business come to us when the landlord requires them to get one. By that time, it's normally hard to get them in a better policy just because of the fact that we weren't able to do a risk assessment on the property that they're trying to get. Another example of this would be take for example, the RV that I just mentioned, the RV client. She already got a property, but then since she can't get insured, she can't meet the minimum requirement for the landlord. So now we've been having problems trying to juggle around and trying to figure out what to do. And now, she can't operate and she has a property that she has to keep paying on just because of the fact that she already established a storefront. And that's the issue that we don't want to see businesses make that mistake. Now, for general liability, the premium are heavily dependent on industry and business operations. What I mean by this is that, first, take a nail salon. A nail salon will probably only cost $600 a month, or I'm sorry, $600 a year to do a small storefront retail business. For something like a trucking company or a truck fleet, we are having truck fleets cost $60,000 in premium a year. And that's also another reason why we want to make sure we get in front of we get the business in front of us to try to essentially figure out if that budget works. Because if you have one contract for a freight company and that one contract does not even cover your premium, then there's no point on trying to essentially establish that kind of model. Like I said, the best thing is it's never too early. Just contact an insurance advisor. It's pretty simple, pretty explanatory. Next thing is professional liability, or E&O. A perfect example of this is malpractice. Everybody know what malpractice is. It's pretty simple. For startups, another professional liability is D&O, basically directors and officers. It is very imperative that they have that, or that you guys have that for essentially when you guys are doing contracts or starting out brand new, you have your officers. Normally founders are not are not experienced with contract work or how to manage a company, and you may get in trouble for either breaking an NDA or breaking a partnership contract. And this was what covers that, professional liability. So in certain industries, it is mandatory by the state to have a professional liability coverage. You cannot operate a business without it. If you're caught operating a business without it, there's a cease and desist letter and of course fines. And this premium will be dependent on the number of employees and what their classification is for the professional liability. And what I mean by classification, that is going to be your industry classification, and what are, if you're just a desk worker, or if you actually go out and walk around the floor, or being a sales consultant, whatever. The next common thing is your business personal property. Now, the business personal property are for your personal equipment inside the building. So if you have printers, computers, whatever equipment you have that belongs to the business is going to be covered by the business personal property. And with the co-insurance law, like I said, in Nevada, it's 80% minimum. So you make sure whatever value is inside that building, you're covering at least 80% of it. And then next thing is workers' compensation. This is mandatory by Nevada for everybody to have. Worker comp, if you have employees at least. If you have employees, you have to have workers' compensation. And this covers your employees' medical expenses during duty, if they sustain an injury during duty, and duty-related things, as well as employment loss of wages, and worst-case scenario, legal fees. If you get sued saying that your business are handling chemicals that they weren't told, then this will cover that. And again, this is dependent on annual payroll. This is reported to the state. So make sure you guys have this, because the state will find out, and the fine is a lot bigger than what it'll cost to insure. So for more protection, there's various different policies in place. Like I said, it's very, very dependent on what your operation is, what your business is, what product you're selling. As a startup or as a founder, we mostly see them trying to obtain a product liability. One case in point is we have a client right now formulating he has a formula that includes CBD in it, and will requires that FDA testing. FDA requires you to have a product liability just for them to be able to test it. So normally that's what product liability is. Also, if you have, like, say, a code or machinery, product liability will also protect any lawsuits against injuries from that. Your inland marine is essentially transportation. If you are transporting equipment, or some of your equipments are being transported, or your business deals with somebody else's equipment, you would need inland marine. Inland marine covers any damage taken while it's in transportation. And then, of course, you got your cyber, which protects essentially any data breaches, loss of income from those data breaches, lawsuits against for essentially if you were, if you had the server, you went down, they will actually cover that server and whatever loss you made because you couldn't operate since the server was down. And of course, you got your employee dishonesty and essential. There's hundreds of different liability or policies, and that's why it's best to get started early on and start thinking what you would need protected and what your operation looks like. Then you get to the issue of how do you actually get insurance? To start off, we'll talk about captive agency. Captive agency is what most people know. It's basically your Allstate or your State Farm. You see their little sign out the door. You go in there, get an auto and home insurance. You can't really do that for business. If you try to go do that, most of the time, if you are not a standard business, they will refer you out. They will refer you out to a broker. And that's when you get the independent brokers and agencies. Your independent brokers and agencies, they're the ones that has access to large business carriers. They're the ones that doesn't, but they do not work directly with insurance carriers. So they don't work for the insurance carriers. They're not on their payroll, they're independent. And again, the standard access for that is about 20. So most brokers have about 20 carriers underneath them. And if they expanded, they normally have about 100 to 150. Now, when it stays standardized, captive agencies are standardized because every agent or every building has to follow the same protocol, they have the same resources and everything. A broker, however, doesn't. So essentially, a broker may not even offer advisory. They just may offer you access to those carriers, and then they'll just plug your numbers in and give you a quote and give you a policy. Some don't have risk teams. Some don't have certain carriers. For instance, a weapon company. If you're manufacturing any weapons, there's only 6 in the world that will insure you. There's only 6 carriers in the world that will insure you. A lot of brokers don't have that access to that carriers. So whenever you guys are shopping around, make sure you ask questions on the brokers. How are they going to help you out and the whole process and what kind of insurance carriers they have? Because if they are not assisting you in the whole setup, and you would probably have to, I would recommend looking for a different broker. And it shouldn't just be a quick, simple, oh yeah, I'll plug in your number, you're good to go. It takes a while. For instance, one of our client has been working with us for 6 months on just to get his policy, and that's because he's trying to draft up operation plans and everything that the insurance carriers would want, and we have to see everything, including how many employees he has, how much each of them are getting paid, everything. So shopping for business insurance is not that easy unless you're a standard mom and pop kind of business. Then you would actually need an independent broker or advisor behind you. Okay, so I know it's really quick and simple. I just didn't want to make it too complicated for you guys because there's a whole bunch of regulations and laws, and especially if a business starts crossing states. So it was just to get you guys feet wet and start thinking about things and starting to figure out where to go. But yeah, so we talked about the core insurance. General liability was the general liability, business proposal or business property, as well as workers' compensation is going to be the biggest core things in your policies. Anything extra after that is going to be based on your business and how you operate.
Ezekiel, thank you so much. Appreciate it. We will not have a session next week. We understand there's going to probably be a number of our founders that have kids in school, and it is spring break. So we want to account for those founders. We will see you all on Thursday, the 23rd, for a session on setting up a website, email, and social media. All right. Take care, everyone.